Bitcoin ETF outflows hit $253 million in 2 days as SPY and QQQ bleed a record. 64 billion spot Bitcoin ETFs lost $253 million over the past 2 days, snapping a 6-day inflow streak that had pulled in $963 million just last week. The reversal coincides with a broader risk-off rotation across U.S. equities. SPY and QQQ have now shed $64 billion combined over the past 3 months, the largest outflow on record, representing roughly 5% of total assets under management. As of March 21, 2026, Bitcoin is trading at $70,632, 0.09% over 24 hours, with the Fear and Greed Index at 32, fear. Crude oil has risen 53% since the U.S.-Israel-Iran conflict escalated on February 28, crossing 730 in the latest session alone. The 6-day streak dies at 7. The streak of Bitcoin ETF inflows that began March 9th was the longest since October 2025, when 9 consecutive days of buying brought in nearly $6 billion and pushed BTC to its all-time high above $126,000. That comparison no longer applies. Outflows began Wednesday and accelerated Thursday, with a combined $253 million, leaving U.S.-listed spot Bitcoin ETFs over the 2 sessions. The reversal tracks almost perfectly with the equity sell-off. The same institutional allocators who piled into risk assets during the March recovery are now pulling back as the war expands and oil prices climb. Monthly Bitcoin ETF flows remain positive at $1.48 billion, but the trajectory has shifted. From November through February, cumulative outflows reached $6.3 billion, as geopolitical uncertainty and declining tech earnings drained appetite for risk assets. The 6-day inflow streak looked like a trend reversal. 2 days later, it looks like a dead cat bounce. Record equity outflows. Drag everything down. The $64 billion in combined SPY and QQ outflows over 3 months is not a normal correction. It reverses roughly $50 billion in inflows from November, meaning the entire post-election rally allocation has been unwound and then some. Bitcoin, the S&P 500, the Dow, the Nasdaq, and gold all declined in the latest session. The only major asset class moving higher is crude oil, which has been on a relentless climb since the February 28th escalation. At $7.30 up in a single session, and 53% higher since the war began, energy costs are eating into consumer spending and corporate margins simultaneously. The correlation between BTC and equities remains stubbornly high. Bitcoin was supposed to be the uncorrelated hedge. In practice, when SPY sells off this hard, institutional BTC allocations get liquidated alongside everything else. Net realized profit-taking in Bitcoin briefly accelerated to around $17 million per hour on a 24-hour average before losing momentum, according to Cointelegraph. The $55,000 question analyst Finnish Crypto flagged a potential Bitcoin bottom around $55,000, with recovery unlikely until geopolitical tensions resolve. That would represent a 22% decline from current levels and a 56% drawdown from the all-time high. The 2022 precedent is instructive but not reassuring. When Russia invaded Ukraine in February 2022, Bitcoin initially sold off, then rallied 24% over 4 weeks as traders bet on a quick resolution. That resolution never came. BTC dropped 64% by November 2022, bottoming at $1,500. The current conflict is different in scale and geography, but the pattern of early relief rallies, followed by sustained grinding declines, is worth watching. The March 9/16 inflow streak may have been this cycle's version of that initial post-invasion bounce. For crypto card users, the practical impact is straightforward. Anyone holding BTC or ETH balances on their card will see purchasing power erode if prices continue lower. Cards funded with stablecoins sidestep this entirely, which is why USDC and USDT-funded cards tend to see higher usage during risk-off periods. Oil at 53% is the number that matters. Crude oil's 53% rise since February 28th is the connective tissue between the war and the sell-off. Higher energy costs compress corporate earnings, bad for equities. Squeeze consumer budgets, bad for discretionary spending, and make the Fed less likely to cut rates, bad for all risk assets, including crypto. The M2 money supply gap that already suggested Bitcoin should be trading higher based on liquidity alone is being overwhelmed by energy-driven inflation that tightens financial conditions regardless of what the Fed does. Global M2 data pointed to $136,000 BTC, but that model assumed stable energy prices. With oil still climbing and no diplomatic resolution in sight, the macro setup for Bitcoin and equities remains bearish, until one of two things changes. Either oil prices peak, requiring a ceasefire or demand destruction, or the Fed cuts rates aggressively enough to offset the energy drag. The March FOMC meeting projected just one cut this year,